Welcome back to our intermediate financial accounting class. In our last few segments, we've been talking about earnings per share, why it's important, what numbers have to be reported, what the rules are for calculating weighted average shares of common stock outstanding, how we calculate diluted earnings per share, and how we avoid dilutive versus anti-dilutive securities and get them accounted for appropriately. Now that we've gone through the calculations of EPS, it's time to take a few minutes and do the journal entries for these dilutive securities. Yes, that's the piece that's been missing in our discussion, are the journal entries. So we're going to start this part of our discussion talking about some journal entries that we've already looked into in prior chapters, but hopefully this will provide us with a good review, and then we'll build up to the journal entries we haven't seen before for stock options. So let's start by talking about convertible bonds and convertible preferred stock. The basic rule is that we're going to take the book value of the bond, this would be the bond payable account, the premium account, the discount account, and move all of that into common stock. So we'll debit away the liability accounts and credit the equity accounts. If we offer an incentive, try to encourage people to convert, then we'll record that conversion incentive as a conversion expense. For convertible preferred stock, the basic principle is the same. Again, I'm going to take the book value out of the preferred stock accounts and put it into the common stock account. The only difference is that this time we're dealing with equity, moving it from one kind of equity to a different kind of equity rather than moving from liabilities to equity. Again, if there's a conversion incentive, that becomes a conversion expense. It doesn't roll into the common stock accounts. And if I need to, for both of these types of conversion, I'll use retained earnings as a plug. You see, I have to make sure that I have at least the par value of common stock going into the common stock account. I don't have to include anything in additional paid in capital, but I do have to have at least the par value in common stock. So if I need to, I'll use retained earnings to get us up to that minimum credit amount. Let's take a look at examples of both of these. Again, we've seen them in the past, but for the sake of the fun of doing the journal entries again, let's take another look. So our first example will be a bond. This is Simon Corporation. They issued a $10 million 5-year 15% semi-annual bond at the beginning of year 7 for $119. So they issued it at a premium, a 19% premium. The details of the bond are here in the middle. Each $1,000 bond, again, that's the standard. We assume they're $1,000 bonds, but this time I've made it explicit, carries a 10-for-1 conversion option for Simon's $5 par value common stock. The conversion period only lasts to the end of year 8. And this is pretty common for debt. Usually I put some kind of a limit on there. I don't want people receiving 9.5 years of payments and then converting in the last month. So I'll put some kind of a limit on there. I still get the benefit of that extra premium that people pay to get the conversion option, but I don't risk making a bunch of payments and then also having to give them a bunch of stock. Simon uses the straight line amortization method for premiums and discounts. We don't have to make that assumption, but we're going to in this case, because we're not talking about bonds, we're talking about conversions, and we don't want to take too much time doing bond tables that we've already looked at in the past. So we want to make the journal entry to convert 60% of this $10 million bond on the last day of year 8. And we're going to offer a $10 incentive per share. So not per bond, but per share of stock to get them to convert. And keep in mind when you're looking at conversion incentives, you can structure that any way you want to. We could do it per bond. We could do it on a specific day. We can do it by shares of stock. We can just give them a specific amount. Hey, if you convert, you get X. We can do anything we want to try to encourage them to convert. The idea here with a conversion incentive is that I don't want to keep making the interest payments. So I'm going to sweeten the pot a little bit to get you to move to common stock and relieve me of that interest burden. The first thing we need to do is figure out what's in our accounts for this bond. Remember, we're going to pull out of the bond accounts and put those values into our common stock accounts. So first things first, what's in the bond payable and bond premium account? And the best way to start that process is with the journal entry that occurred when we issued the bond. Hey, you knew these journal entries were coming. I was going to find ways to do as many as possible. We would have gotten cash at 119% times 10 million gives us 11,900,000 in cash. I record a bond payable for the face value, and the difference goes into the premium account. That becomes our plug. And this is our original entry. And if I was really worried about the bonds, I'd put in a lot more details about how I got my calculations, but we'll keep it simple for now. The next thing we need to figure out is how they've been amortizing away this premium. Because we're using the straight line method, every period a little bit of the premium is going to go away. And the way that we do that with straight line is we take the value of the premium from that initial entry times n, where n is the number of years, 5-year bond, times 2 because it's a semi-annual bond. So 1,900,000 divided by 10 is 190,000 per payment. Last thing we need to do before we actually jump into the journal entries is figure out how much has been amortized away up to this point. We issued the bond at the beginning of year 7. It is now the end of year 8. If I make semi-annual payments, I have made 2 payments for year 7 and 2 payments for year 8. So I have made 4 payments so far and have amortized away $760,000 of this $1.9 million premium. And now I have everything I need to get my T accounts done. I know the original bond payable amount, I know what went originally into the premium, and I know what's come out of the premium. So let's take a look at those T accounts. So we have our bond payable and our premium account. Bond payable started with $10 million. Premium started with $1.9 million. I haven't done anything with the bond payable yet because I don't make any payments on a bond until the very end when I make that lump sum payment. But I have amortized away $760,000 of this premium. So as of now, 1.9 minus the 760, I've got 1,140,000 in this premium account. Now, if all of these bonds were converting, I would debit bond payable for 10 million, I would debit premium for 1.14 million, but they're not all converting. Only some of them are converting. We're told that 60% of the bond is converting. So that's $6 million of bonds payable that's going away. And 684,000 of the premium. And just a little caveat here, if they converted between interest payments, then I would have to do a special journal entry and record interest expense and interest payable up to the time we actually recorded the conversion. And that would amortize away a little bit more premium, and I'd have an interest payable that I needed to get rid of too as part of the conversion of the bond. That's not the case here, but just so you know, that's what we do. So let's see, I'm going to get rid of 60% of the bonds payable. That's a debit of 6 million. I need to get rid of 60% of the remaining premium. That's 684,000. I need to put that into my common stock account. But to figure out what goes into common stock, I need to know, is this a par value company? And we're told that Simon has $5 par value common stock. So the rule is only the par value can go into the common stock account. So I have $6 million in bonds that are going to be converted, and they're in $1,000 increments. So I actually am having 6,000 bonds converted into common stock. Each bond gets 10 shares. So I'm going to give these 6,000 bondholders 60,000 shares of stock. And each share of stock is a $5 par value, $300,000. And that's what goes down here into my common stock account. Now we look at that, it's pretty obvious this does not balance. Anything we get above par value when we issue stock goes into additional paid-in capital. Just because I'm getting my bond waived instead of getting cash doesn't change that basic principle. So additional paid-in capital common stock will get the rest of this 6.684 million. And that makes it balance. Now I could stop here. If there was no conversion incentive, this would be the journal entry to record the bond conversion. In this case, there is a conversion incentive, so I need to record it. But the nice thing is it doesn't change that part. Conversion incentive, no conversion incentive, this piece stays the same. What changes, if there's a conversion option, is I record a conversion expense. And in this case, I could call it a bond conversion expense. It can be a preferred stock conversion expense or whatever, but it's a conversion expense. In this case, for every share of stock they get, they also get $10. So up here, I figured out that it was 60,000 shares of stock, $10 incentive per share. So I'm going to pay out an additional $600,000 in cash to get these people to convert. So I debit conversion expense for $600,000. I'm paying them cash. Conversion of 6,000 bonds for 10 shares of common stock per bond and $10 per share of stock, or something like that. Just enough of a description that we know what's going on. Now again, the nice thing about converting bonds is that middle piece stays the same every time. The only thing that changes is if there's a conversion incentive, then I add that additional piece, a conversion expense of some kind, and then whatever I'm giving them as an incentive. Can be extra shares of stock, could be cash, could be some other asset. For example, Apple could give away an iPad to try to get you to convert, etc. Now that's our first example of convertible securities and how we do the journal entries for them. When we come back, we'll take a look at how we record preferred stock. More fun journal entries coming. I'll see you then.